Good morning, Mike and Corey here today. First day of the training year, first day of the second half of 2024. And today's topics, I'm going to do a brief coverage of the fantastic first half of the year. So we love that. Hope that continues. I'm going to hit a little bit on value versus growth, the difference between those kinds of stocks and the performance so far, and then 6% of your pay in your 401k, automatic by the employer, a change in attitude over the last several years. And then Corey is going to hit, get your Nike shoes out. Is it time to get rid of them? Is Nike done? Their stock certainly hasn't performed well lately, and revenue has slowed down. But Corey's going to hit on that. But before I get started, I must remind you, this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone, and not the CEO of Nike's. So, because they probably don't want us talking like this. So let me get started. Our first topic, end of the first year. This is the graph already for today. Green, green, and green. We love to see that. Dow, S&P, NASDAQ up a little bit on the first day. Who really cares? It could be red by the end of the day. Things go up and down. But I wanted to show, and I'll spend much more time on this Wednesday night on our investor update, kind of the first half of the year, how things are going and projecting into the second half for election season. But let me show you some graphs, very pretty graphs. Here is the Dow year to date. It was only up like 3.5%, so not a lot. There's only 30 stocks in the Dow, and it's not tech heavy. The S&P 500, you can see this one up, I think it's 14.5%, if my memory serves correctly, but it's up, and that's good. Market weighted, driven a lot by the same stocks that drove it last year. NVIDIA, Apple, Amazon, Google, Microsoft, the heavy tech stocks. And then the NASDAQ, same kind of thing, up. So up quite a bit for the first half of the year. So those are all great graphs. We'll spend more time. Do we expect the second half of the year to be up 15%? I don't expect it's going to be up that much. If we said at the beginning of the year, for the entire year, we were up 14.5%, I would say that's a great year. Well, we're halfway through the year, and that's where we're at now. So the rest of the year could be a little bit more choppy with presidential elections and whether we get the soft landing with the Fed and all of those great things coming up, but we'll cover more on that. Wanted to talk about the difference between value and growth stocks, ETFs. We'll just group them over also, ETFs, pulling this from Investopedia. So value stocks, and I'm going to show a couple examples of these, but value stocks have a lower price to earnings ratio, and they tend to be profitable, and a lot of times they pay a dividend, but they are below their intrinsic worth. Growth stocks or growth ETFs are those faster growing, high PE, and tend not to issue dividends. And a lot of times, believe it or not, they're not even profitable yet. I mean, so the ones that have driven this year are profitable, but a lot of times as they come up, they're not yet profitable. They're just counting on being profitable at some point. What it is with that, and I highlighted this, growth ETFs, and I'm just using the ETF to group them all together. I'm not speaking to one specific stock, but a growth ETF may have higher long-term returns, but comes with more risk. They go up faster, they come down faster, and then they snap back more quickly when the market comes back up. Value ETFs are more conservative. So when you consider that the market is volatile, like we don't know yet, but we may experience in the second half of this year, they're less fluctuation. So there's a side to that. And what I want to do is show some examples of value stocks. And on this, they give AT&T, which pays off a nice dividend, Procter & Gamble, which is close to me here in Cincinnati, General Electric. I don't know if I consider that value as much anymore, but Coca-Cola, certainly, they're very stable stocks. And most time you've heard of these big ones here. Hopefully you've heard of all of these. And one of the benefits of these value ones is they typically generate dividends. And then let's go into the growth. So here's the growth ones. And these are the ones you tend to hear more from Ankerstar Wealth because we invest a lot of direct positions in these. Not Tesla. We don't invest directly in them in the book, but definitely Meta, Amazon, Alphabet, Apple, not shown here, and some other ones. High returns, small dividend, high fluctuation. And then even these other ones listed, I'm not even sure that I've heard of any of these ones. A couple of them I have. But I wanted to show you a graph. And what I'm pulling out is the iShares, the difference between growth and value so far this year. And since we're kind of 6 months through the year, the market's up great. The higher graph, the 25% is growth, and the 4% is dividend. That's the growth of the stock. That doesn't reflect the actual dividends they paid. So that 4% is really a little bit higher just because it generates some dividends, but still maybe it's 7 or 8% total return tops. And you can see that performance that growth has had. But let's look back. Let's look back more than year to date. Let's look at 1 year. You can see growth has outperformed quite a bit. Although when you go back a year ago, when the market dipped, you can see that growth really came down and value was much more flat. And let's look at a 5-year graph. I'm going to break it back, and it looks even kind of worse. You can see the value stocks kind of a little more flat. And let's go all the way back to 2000. And you can see that growth has done better in the last 5 years. And that's the key point I wanted to show on this. If you look from 2000 to 2019, that's the break even. But you can see most of the time, value stocks were ahead of growth. And then it's only in these last 5 years where it's really, really surged the other way. So anyways, I just thought I'd show you that. As we make decisions for models and portfolios, we realize that it cannot run forever. Growth cannot always outperform value. It eventually has to spread or fluctuate back and forth. Otherwise, the growth stocks would just leave value in the dust forever, and that will not happen. So making decisions on that correct balance is part of our job. The last topic I wanted to cover before I flip this over to Corey is I saw this article in the Wall Street Journal. Some of you I know are dying as soon as you start work at a company. When can I put in my 401k and get the match? Yeah, that's the way I think. I'm like, how do I get that match? And you should always put in your 401k to get the match. That is free money. That's free money. If they'll give you a 50% or 100% match, we can't beat that return when 1 day your pay comes in and you get a 50% match. So free money always take. But the key with this article that I thought was interesting is I've worked at some companies where when you start, they're just like, hey, we're going to automatically put you in at 3% into your 401k. And I'm always like, what's the match? Because that's what I want, whether that's 6% or whatever. But what we're seeing is companies now are starting to enroll a default 6%. And that green line shows you that in, up through 2023, about 30%, it defaults your pay into 6%. And you can obviously opt out of that. And the number that defaults in at 3% is declined. In fact, there's one company, I think it was Verizon, it's up to like 91% of the people are 6% or more, which is great because you want to save up for retirement. Guess what? Companies don't pay pensions anymore. Very, very few do. So they know that your 401k is critical. So just thought I'd show this trend and just reiterate to all of you listening, if you have a 401k that has a match, you definitely want to get that match if you can at all afford it. Now, after that, you need to talk to your advisor because there's some disadvantages to 401ks. For example, you don't have the selection of investments that you do in an IRA or an account with us or in Schwab. So you don't have that choice. And a lot of times the choices aren't the best or they're higher fee. So if you're like, I'm going to put 10% of my money into retirement and my company gives me a match on 6%, you might put your first 6% there and then use a traditional IRA or a Roth IRA for the other 4% to have more flexibility. But that's something you definitely want to talk to your advisor on. So with that, since I'm sure some of you probably aren't holding Nike stock, but you might be wearing Nike shoes, I'm going to turn it over to Corey.
Thanks, Mike. Hey, and I love that growth versus value chart that you shared with us. One thing that's always in the back of my mind are those decades, kind of those lost decades that we've seen over throughout history at different times, and how during those decades, those valued stocks really give you the bulk of your return. So if you're running a diversified portfolio, you should always be partially ready for that transition, even though hopefully, tech can lead us higher for many years in the future. Okay, right here, looking at Nike, is this the end of Nike? Well, it's down a little more today. It was down 20% on Friday. We see back here in 2021, we had a peak up around right at $177 a share. And since then, we've had what they call lower highs and lower lows. So that's kind of a traditional downtrend. And you could try to kind of read the tea leaves here and find a level, but it's clearly in a downtrend. And we just got another lower low, breaking this low from September of 2022. So the question is this the end of Nike? Is Lululemon and Hoka and all these other new companies, are they eating Nike's lunch? Well, let's take just a quick look at just one part of their financial statements from last week. One thing that's interesting, so you can see up here at the top, revenue was down 2%, and that is not what investors want to see. At the end of the day, growth is the most important. Revenue growth, pure revenue growth, is the most important thing for a business to sustain itself over time. If you start entertaining shrinking revenues, then it's going to be hard to not become a shrinking company. Will these, and Nike is projected a little bit higher revenue decrease for the remainder of this year. But down here, Nike has been adjusting, and they've really committed to a streamlined business model. They've cut a lot of expenses, and they're in one of those transformations right now. You can see that overhead expense, they did drop by 9%, which is a really big commitment to efficiency there, because and that is their largest expense, other than the actual products themselves. But you can see that their net income actually increased 45% from a year ago. So they're operating in a really efficient way. They're clearly doing their best in this harsher environment. And would we expect? Do we think that Nike is being, is going to dissipate? I don't see evidence of that yet. Margins are still really strong. Margins were up slightly, and we don't have evidence of anything catastrophic yet. Of course, though, that revenue number is something for us to watch as we look forward. And Mike, I don't know about you, but have you seen over time, can you name a couple of brands that have kind of come and gone, and Nike remains over time?
Well, you think of the shoe brands, and as a wearer of New Balance shoes, because my feet are extra wide, I did see the Nike movie earlier this year. I can't remember what it was called, but it was about Jordan signed with Nike way back when. But trying to think of brands that have come and gone. I mean, we've seen, a lot of stores, restaurants kind of come and go. As far as shoe companies, I guess I don't really pay attention enough. I know that we covered Golden Goose and their used
Oh
looking
yeah.
expensive shoes, but they pushed back their IPO. But
Mm.
trying to think
I
what
remember
brands.
when I was growing up, there was this big shoe company. It was called And One, and they were all over TV and basketball. And I just thought they were so cool. And now I don't know if you could even find one anymore. And then you can't find one and one right now, I guess. But then another one, oh, Under Armour was
Ah,
one that was very popular when I was growing up, even throughout college, and they have really struggled. And if you look at their income statement, it looks
hmm.
much worse than Nike. So Nike's struggling, but they might be holding stronger than their competitors.
And I think what's amazing when you were showing this chart, you don't need to bring it back up, but in 2022, if you bought Nike and you were like, this is the premier shoe company, well known, phenomenal brand, $175 a share, and now 2 years later it's trading at like $75 a share, you've lost over 50% of your value or your dollars there. And it just shows that how difficult it is to sometimes pick a company. I mean, if you told me, Nike 2 years ago would drop this much, I'd be like, there's no way. There's no way, especially considering the way the economies went. I mean, yes, we can say inflation's went up, but overall the economy has done well. I mean, the stock market's done well, and and this is the danger when you just buy this. Let's just say the S&P 500. Guess what? You own Nike. Nike's in there, and that little piece of your 500 stocks just dropped 50%. So it's interesting. Do I think they're going to go out of business? Of course not. I mean, it's Nike. You showed the fundamentals on it. Gross margin's good. They're cutting costs. They're just not growing like these tech stocks that we're invested in. So therefore, their
Right.
stocks they're sinking. So thank you, Corey, on that. And you know, I remember when it was only Nike and there was no Under Armour. They did come up. They kind of came in the last like 20 years to try to take Nike's lunch. But it's probably harder to run these shoe companies. And of course, I did see Michael Jordan actually play, and now now he's just a picture on your shoe or your background or something. So maybe they need another star to kind of take them to the next level. If they get one in like a double extra wide, I'll volunteer, and maybe our podcast will take them to the next level, right?
I love it. I love it.
Uh, awesome. Well, thanks everybody, and we will talk to you tomorrow. Bye.